Hello everyone, this is Tina, guest market analyst from FPG. Today is 13th February, Thursday. Overnight US inflation reported hotter than expected, which strengthened the odds for the Fed to slow down rate cuts. The US government bond yield have surged, however, the US dollar index didn't respond to it, weakening slightly against other major currencies. So it is the reversal trend of the dollar. All the rebounding in the other currencies are only temporary. In the following video, I'm going to talk about the market trend of the euro against US dollar and the British pound against dollar. So the first one, let's have a look at the euro against the US dollar. Since mid-January, the euro has been moving a slight uptrend against the dollar, consolidating around its lows. At the moment, it's still moving in this triangle pattern. So this year, the US stock markets have stopped surging as well as US dollar. The US government bond yields also slowed down its upsurge. I think at this moment, investors are cautious about Donald Trump's tariff policies' impact on the other major economies. I believe in the long term, the US dollar will likely stay strong. So from this period particularly, the near-term resistance would be the trend line as well as the upper band, the Bollinger Band, around 1.0530, and the euro could continue weakening against the dollar in the long term. Once it's break down below the previous low, it might choose continue going down, even reach a parity level. The next one is the British pound against the dollar. The British pound it also rebounded from its bottom. However, here we can see potentially forming a double top pattern is still moving under this 50-day moving average. So there are no fundamental factors that support a strong pound. It might continue going down from the 50-day moving average, and the near-term resistance we can use double top around 1.2540. So in the short term, I would expect it would still move in this triangle pattern. And in the long term, I think pound would still weakening against the dollar. A key support would fall on the previous low, about 1.21. So I believe the US dollar would still go stronger. One is because the Donald Trump tariff policies will likely put upside pressure on the global inflation. And the second, US CPI data accelerated again in January. I think the Fed would stay hawkish at this point, and the markets are pricing in only one rate cut this year. At the same time, the other economies like Europe, China, and Bank of England, they are on course of rate cuts. So currency traders might choose to buy the dip in the US dollar and support a long-term uptrend in the dollar.